Welcome to another episode of Rich Dad StockCast. I'm your host, Denney, and today we're diving into a major topic that could impact your investments, tariffs and your wallet, what Trump's plan means for your stocks. Now, tariffs can sound like a confusing political issue, but make no mistake, they directly affect your portfolio, your business, and even the prices you pay at the store. Now, with Trump's latest tariff proposals, investors need to understand what's coming and how to prepare. Now, to break it all down, I've brought back one of the best investing educators in the world, at least in my opinion, is Rich Dad expert Andy Tanner. We're going to cover what tariffs actually mean for stocks, which sectors might get hit the hardest, how smart investors can turn this into an opportunity. Now, before we dive in, make sure to grab your free investing tools and resources at stockcastbonus.com. If you want to make smarter financial moves, we've got everything you need in there. Actually, Andy, tell us, what exactly do they get inside stockcastbonus.com?
Well, it's interesting. We just finished a really interesting challenge with all of our followers on Facebook. And the challenge was to make a really major pivot and start to instill habits. You know, there's two parts to it. There's the education that determines wealth, and there's also habits that determine wealth. And this the StockCast bonus has a free ebook that really helps meld those two things. In fact, I would think it would be impossible for a person to take that free resource, just eat it up, just love it, consume it, and on the other end, you'll say, "Wow, this is education on one hand, and then also a key to really healthy financial habits that bring a health to the financial statement and wealth to the individual." So it is a life-changing challenge that we just went through a week or two ago, and it really starts with the things that we share in that special ebook. And the fact that it's free is something we're very proud of, because the whole idea is to elevate financial well-being, and that's done through education, and it's done by the personal development of new habits. So if you're curious about what those are, go check it out. And one thing I don't make guarantees very often, but the one thing I can guarantee is you'll have an illumination of education and habits change your life. So we're happy to advertise that and to give it away for free.
That's fantastic. Now, going with the theme of our topic today, tariffs. Tariffs are something that a lot of people hear about in the news, but they fully don't understand it. Now, let's start with the basics. What exactly is a tariff, and why does that matter to the average investor?
Yeah, it's interesting. Well, I wouldn't be an expert on tariffs any more than I'm an expert on anything else, I suppose. But as an investor, you want to at least be aware. So on the education continuum, I don't know how far up I am on that, but a tariff is basically a tax. It's a surcharge of sorts, where someone that's manufacturing and wants to import something into a different country, the country says, "Look, you want to sell to our people, you're going to pay us to do it." It is I have a lot to say about it for having maybe less knowledge. I don't think most people call me up, want me to talk about 401ks, so I don't know that anyone would call me up and say, "Andy, teach us about tariffs." But I do have some feelings about them, and the thoughts on how they might affect the market will be interesting. But a tariff is a tax. It's a surcharge, a tax on imports.
What do you think the goal of Trump's proposed tariffs really are?
Well, I think a lot of it has to do with competition. Donald Trump is a competitive guy, and he's won a lot. He's been in a lot of wrestling matches. He's won some, he's lost some, and most recently, he's really won one. So when you look at it from a competitive standpoint, that's where I would begin. Globalization, this is a great debate, and it's something I still want to learn more about. I look at this current event as an opportunity to learn more, always. But always there's two sides to a story. So on the one side, I think you begin with competition. Globalization is what we call it's deflationary. So, for example, if I can outsource labor to a place like China where, it's maybe a step above slave labor. I don't know. I've heard pretty scary stories that if you can get things manufactured for people that are willing to work for almost nothing, or that have to work for almost nothing, that can give you a tremendous competitive advantage here at home. So when a person, studies COVID, where we couldn't import, we had nearshoring, meaning things were just caught and stuck, and the wheels of the economy were grinding, just trying to go along. We had inflation, not just because we dumped a bunch of money in the economy, but because things were scarce. A true supply and demand inflation, which the Fed tried to label as transitory. They said, hey, it's not the zillion dollars we've printed. It's the supply chain is got problems. So we do know that globalization is deflationary, that it's certainly cheaper to send things overseas into countries that maybe don't have the standard of living that we have. And so on the one hand, a business owner might say, well, gee, I don't like the tariffs. And the stock market, to answer your question, the stock market might look at that and say, we don't know what's going to happen with this. And the stock market does not like uncertainty. When in doubt, pull your money out is the way traders think. And so we'll see some volatility in the stock market. Now, this is wonderful news for someone like me. I absolutely love volatility in the stock market. There's nothing I love more. As an options seller, premiums are fat. The fear gauge, the volatility index that measures option premium, what people are willing to pay for insurance to protect them against the uncertainty. I sell that stuff. So for me, it's an increase of cash flow, and I couldn't be happier. The other thing is, if we can have big dips in the S&P where I can acquire more assets cheap, I look at the S&P like a real estate investor looks at land. You look at land as a limited resource. There's only so many shares of lots of land. I also look at production the same way. There's only so many shares of the S&P 500, and the more of those I can get, the more production that I own. To me, it's a very real thing. And so those two ideas, volatility where people panic and make things cheaper, and then the ability to sell options at high prices, it's glorious. So I actually love the uncertainty, and the tariffs bring that. Now, this is kind of maybe a longer answer than you wanted.
This is exactly what I'm looking for. No.
Here I come out and I say I don't know anything about tariffs, but I tend to pontificate on them. So on the one hand, you have competition where businesses say, well, gee, I'd love to have stuff made overseas. Well, if you're China, there's a real point I think Donald Trump has in saying, look, we're your customers. Why should we let your cheap labor, compete with the cheap labor we get from you? And so by charging a tariff, you're charging a premium for the consumers. And this actually makes business sense in a lot of ways. For example, if I were to go to a trade show, and I want a booth at the trade show, and I sell pharmaceuticals, and I get a booth at the pharmaceutical convention, I'm going to pay a premium for that booth. I'm going to pay a tariff maybe on what I sell, just for the chance to be in what we might call a target-rich environment, to where I'm talking to the people that can make me the most money. Well, if we have wealth in our country and we provide the consumption, they need us. They need us to consume. Why wouldn't you say, hey, this is a target-rich environment. We're your lifeblood. You want to sell in our country, you got to pay a little bit, and you got to help. Then we can kind of compete against that. So it is inflationary. There's no question. It's inflationary, but it's all about competition too, the supply and the demand, and it can decrease a little bit of their demand, make it a little tougher on them. I think there's a real good point that I'm not Democrat or Republican, so let me declare that I just want to know the rules of the game and sell premiums. I'm kind of maybe I'm a little selfish in that way, that I'm in it for Andy, Marcy, and my 2 kids. That's what I'm trying to do. And I'm in it for you guys, for your families. And so I don't try to move political needles. I just try to understand them as best I can. But there is an interesting point the Republicans make in that, the middle class gets crushed, and manufacturing is really important. I mean, manufacturing really helped the middle class become broad and wide and raise their standard of living. Well, now you have a concentration of wealth in finance, real estate, stocks, concentration of owning the assets rather than the manufacturing. Well, this will help manufacturing, I think, because of the tariffs, make it expensive, and so maybe people, can look at manufacturing and have it as a boost. We'll see. But it is an interesting thing. Do I know what's going to happen? Don't know, don't care. I actually enjoy, again, the uncertainty of it because it creates volatility in the market, and I absolutely love the volatility positioned where I am. As a person who doesn't really care much about net worth, our T-shirts that we have say cash flow is greater than net worth. Not numerically, but in principle, it's just a better place to position. So if there's volatility in the market and my net worth changes, but cash flow increases, I'll take the increase in cash flow, and because the volatility of the net worth, it's not the most important number in the balance sheet or in the financial statement. It's just not, and it's temporary. It floats. It's like Zillow. They send me these alerts on the properties I own saying, oh, your property went up in value, down. But what do I care? I'm not selling it. Why would I get rid of land? Well, the same is true with my stocks. I own great companies. Companies are going to be around for a long, long time. Let their prices be volatile. I prefer to buy more when they drop down, and I prefer to sell the premiums. I welcome. So if the tariffs are going to cause volatility, it doesn't bother me one bit. In fact, thank you for the volatility.
Well, I think that's a good way of framing as you're talking about that. I think of stimulus and response, right? All this is just a stimulus to create the volatility. As you think about that stimulus and the response to different market sectors, what sectors do you think, besides manufacturing, will be most affected by it?
Well, it's tough to say because we don't want to make the mistake of looking at things like tariffs in isolation, because it's only one of many, 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 many variables. I think one of the most fascinating things we'll learn, and it is learning because nobody knows, it is reminiscent of the .com boom, though, is AI is going to increase production. If you look at labor, you could look at AI in a couple of lenses. You could say, well, in my company, I would rather not reduce my labor by firing people and replacing them with AI, as McDonald's has done. So there's going to be some of that. The cashier is going to lose their job to the AI. But the people that we have in my company could actually benefit by using AI. In other words, would I rather lose one employee and replace them with AI to reduce labor costs, or would I rather empower that employee to be 10 times as productive by using AI? So when you look at gross domestic product, whether you sell thumbtacks and paper clips, or whether you sell technology, AI is going to help you be more productive, more efficient, and I would see that the gross domestic product should grow because we can just simply produce more with less. This is a very much what, I always have to nod to Robert Kiyosaki and also Kim Kiyosaki for the emphasis on generalized principles that don't change. And one of those principles is one of ephemeralization, where we simply do more with less, and then we do even more with even less, then we do even more with even less, till eventually you can do everything with nothing. Well, AI is a big step towards doing lots more with a lot less. Therefore, productivity should increase. So, if tariffs are going to, cause some problems in the market, can you really fight the increase in productivity you're going to have? I mean, it's not going to change. It'll change big real estate because they'll make the things they do more efficient. Their pricing will be more efficient, and they'll have algorithms on when to renovate better and all that. But the production in stocks and in companies, to own stocks right now and to get a piece of the S&P or even the Russell 2000 or junior miners, or all this stuff is going to get better because of AI. And I would not fight against it. I would lean into it. So to look at tariffs in isolation and say, well, it's going to cause all these problems. Well, what about the positive things that are going to increase productivity in business? You want to own business right now. If you're worried about labor either shrinking or even being the opportunity, labor being more productive, either way, business wins. And so to own business, if you don't know how to start your own business, which Warren Buffett did not know how to start a business, he bought them instead. And you let the compounding go to where you own more and more. So I don't know if that's the best answer, or I don't even know if it's the right answer, but it's, from where I sit, it seems to make sense.
I think that makes sense as well. And it's more of like, how do we what's the guide that we have going through this? Because none of us really know, right? And so I appreciate that thought when it comes to tariffs. But let's do this. Let's go to break. We've just covered the basics of tariffs and how they impact stocks, but let's talk about how we can what we could do about it. So when we come back, Andy's going to break down how smart investors can protect their portfolios and even profit from tariff policies. And don't forget, if you want free resources and tools to invest smarter, go to stockcastbonus.com and grab your resources right now. Stick around. We'll be right back.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning, as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to Rich Dad StockCast. I'm your host, Denney, and today we're breaking down what Trump's new tariff policies could mean for your investments. Now, let's get back into the good part, how you can protect your money and even profit from these changes. So, Andy, when policies like this hit the market, what's the first thing investors should do?
Well, I think you should learn, and that's always the answer with me. I mean, that people could have answered that question before you asked it. These are always opportunities to learn. One of the things that we didn't touch on in the previous segment that is really interesting about tariffs and why Trump might like them is when you look at our fiscal irresponsibility. It's an interesting political move. There's people that don't like Doge, but when you look at like all these nonprofits, these non-governmental organizations that have just been created to funnel, billions of taxpayer dollars into, I mean, there's a lot of interesting ones. They're a drop in the bucket. I mean, I don't think they move the needle. Our entitlements and our mostly what we call income security, which is Social Security, Medicare, things that are consumed. Our debt is not borrowed to invest like investors. Our debt is consumer debt. Let's be clear. And the interest on that debt is growing. I mean, it's alarming. But what I do like about Doge is the mentality of it. I don't run the Cash Flow Academy. I'm not the CEO because I'm not good at it. And so I learned that from Robert too. You do it. You try to do what you're good at. I try to stay in my lane. But I love his mentality of, if we can save $1, we save it, not because the dollar would make a difference in the balance sheet, but because it's a principled approach. It's an attitude. It's a policy, which I really like, not wasting. But the other thing you've got to consider with tariffs is you look at the fiscal irresponsibility of the United States and the difficulty in solving that problem. You have basically three ways to do it. And I believe we should do all three. The first one is to rein in spending. If you're wasting money, you're less powerful. Of any balance sheet in the world that spends money unwisely is going to be weaker, and that entity will be weaker. So the country is weaker, at least my own country, the United States, is weaker if they waste. So Doge is a policy to kind of get a mentality of eliminating waste. Great. It's less about waste and more about appropriations. No one wants to be on the House and Ways and Means, but everyone would love to be on appropriations. The other thing is you can increase revenue. And that's where tariffs are an interesting idea, because generally in Congress, we look at it in a kind of myopically of fighting over who should we extract the money from in terms of class. What the tariff approach does, which is an interesting approach, is saying, let's not look at it in terms of class. Let's look at it in terms of country, geography. So instead of saying, well, we're going to raise taxes on Americans to reduce the deficit, let's raise taxes on the rest of the world to reduce our deficit, which is a really interesting take on how to increase and change the health of the financial statement. So while on one hand you're saying, well, that's going to cause market volatility and it's going to cause inflation, and inflation's bad for the economy. Well, but if it serves to stabilize the fiscal situation in some way, and so we're not so weak fiscally, because if we're weak fiscally, then you got to raise taxes somewhere and you got to print money, which is inflationary. And so, you're going to have inflation either way. So, why not raise money to pay for things? And, if you're going to have a Medicare deficit, are you going to have the United States taxpayer pay for it? Or are you going to have the Chinese government pay for it through tariffs? So, these are arguments that are really interesting to think about, from a fiscal standpoint, because I would rather do business in a country that has fiscal responsibility and isn't handcuffed to have to print money to grow and then the third one is to grow GDP. I mean, so number one, rein in spending. Number two, increase revenue. And number three, grow the GDP, because that broadens that gives us a bigger pie to take this slice of taxes from. So, I'm not an economist, but, to your more important question when you started the statement was, Andy, how do you position yourself with all this? And this is the beauty of financial education, which is apart from, politics and, political science education, or even economy education. Investor education is different. When I say, well, how should people approach this, and I say through study, there's certain things that don't matter to me. Let me give you an example. If you want to look at a capital gain lens of stocks going up or stocks going down, and you want to take a technical analysis view, a stock can go up, a stock can go down, a stock can go sideways. Why it does that to a technical analyst, they don't care. And so there's a false idea that, if I get into investing, I'm going to be competing with AI and algorithms and high frequency trading and fiber optic networks. And, you just can't compete. I'm not competing against those guys. Look, they can do whatever they want. Stocks still go up, down, or sideways. So if I'm a trader and I have contingency plans for stocks going up, down, and sideways, and I know how to manage risk, there's 1,000 zillion reasons that a stock could go up, down, or sideways, of which tariffs is only one in a zillion things that can cause them to move. So, it's not the tariffs that worry me. It's the thing I never thought of, right? What's the biggest risk in the market? It's the risk you can't see coming. It's the 90 degrees, that punch that comes in, that sucker punch. It's not the guy you're fighting here. It's his buddy who sucker punches you. It's the one you don't see coming. So you can sit and speculate about tariffs or taxes or spending or politics, but at the end of the day, stocks go up, down, sideways. The other thing we know that Jeff Bezos, I brought this up on the podcast a couple times, and every once in a while, a great entrepreneur says something that really gives someone a nugget if they grab onto it. Jeff Bezos, however you say his name, he said something interesting. It goes, when you look into the future, it's probably more valuable or as valuable to consider the things that won't change rather than to anticipate the things that will. In other words, there's solid ground to be found. There's a firm foundation in which one can plant their feet that will be unchanging. For me, these are called generalized principles. And so if I can find and study and identify generalized principles and embrace those, I have a constant amidst chaos. And so to me, that constant is cash flow. And I understand how cash flow comes. Cash flow comes not from gaining, but from earning. In other words, the Smith-Barney lied. They say they make money the old-fashioned way. They earn it. They don't. They just collect fees. They don't earn jack. But the rest of us in the real world, we do earn the money. And so if I can find production, regardless of political environment, here's a constant that I know: food, clothing, shelter, medicine, energy, technology. Those are required now. They're not luxuries. It used to be food, clothing, shelter, but medicine, we're willing to rack up debt for healthcare. It's now a necessity in our minds, right? All these other things, energy, we're not willing to turn the lights off or conserve, or you can global warm threat all you want, but the third world countries are going to burn oil, right? Energy is a constant, whether it's wind, solar, geothermal, nuclear, or fossil fuel. Energy is a constant. So if I am a producer in this world and other people are a consumer of this world, the money will flow towards me. All you got to do is I use the Costco analogy almost every week. Go to Costco and watch the money flow. It is a constant. It flows from the people's pockets into the cash register, and they line up to do it. They stand in line and wait patiently to hand their money over to the producers. So regardless of tariffs and regardless of taxes and regardless of AI and I see that constant flow of cash going from consumers to producers. And I say, well, come what may, I'm going to be a producer. And the way to do that is to own real estate and produce housing and produce or provide, to own stocks and produce food, clothing, shelter, medicine, energy. To be a net producer is a generalized principle. The other thing, which brings us back to tariffs, is Warren Buffett has a little fable or parable, probably more of a parable than a fable, where he calls it Thriftville and Squanderville. There's these two villages called Thriftville and Squanderville, and it's really about trade deficit. If you have a trade deficit, one country will have a landfill, and the other company will have a large bank account. And the money, it's consumption and production. And if you allow your competitors to outproduce you, and all you do is freely consume, it's rough. So, does a tariff put a bit of a headwind on their ability to produce? Well, it makes it harder for them to have us consume. And at least if we're going to consume, we're going to get paid to consume rather than to pay to consume, if that makes sense. So it is a fascinating story to watch, one that I'm more excited to learn from it than try to act like I know about it. I'm more excited to kind of grab my popcorn and watch the movie and see what I'm going to learn about tariffs rather than claim I know a lot about tariffs. But what I do know is I have certain generalized principles, which is a beautiful plug for StockCastBonus.com as it comes to mind, because those are generalized principles you're getting for free at that website. And you can invest with confidence, espousing generalized principles, one of which, like ephemeralization. If you can learn to do more with less, you're embracing a generalized principle. Technology helps us do that. Ephemeralization, doing more with less. The more people I serve, the more effective I become. That's how I'm going to approach the world, regardless of tariffs or no tariffs. How am I going to serve more people is the question that I wake up to every day. So it's going to be great to learn about, we'll learn a lot about how tariffs affect the economy. I would say the last thing on tariffs that's really nice about it, and I think there's a lot to this too. Ronald Reagan, who was the president in my, in a lot of my youth, I was like a Gerald Ford, Jimmy Carter, Ronald Reagan were the guys I grew up on, a little bit of Nixon in my early childhood. But as I look at the ability to it's like walk and speak softly, but carry a big stick. I can't remember what
Teddy
Reagan,
Roosevelt, yeah.
Is that Roosevelt? Whoever it is.
That's Roosevelt.
But I remember Reagan was like peace through strength, I think is what the way he used to put it, is peace through strength. Well, you don't build a nuclear weapon because you want to use it. You build a nuclear weapon so they don't use theirs. There's a big difference there. Well, a tariff is a great saber to rattle. We might not, a great example, it wields a lot of power as a bargaining chip and as a leverage. For example, if you want to take a member of a drug cartel or a gang that's infested themselves in a apartment building in Denver or Chicago, we say, you know what, we're going to clean these guys out. Too much fentanyl. And we're going to send these guys out. We're going to arrest them and deport them. And then Venezuela says, we're not going to let your plane land. We say, oh, that's fine. Okay, we'll land somewhere else, but you will have a tariff that'll bring you to your freaking knees. So if you're not, so there's some leverage to tariffs. Is it saber rattling? Well, I don't know. It is a deterrent to fighting what is in our best interest or what might not be fair. We don't want to treat other countries unfairly. We don't want to be the policeman of the world. We don't want to be a tyrant in the world. But if people are treating us unfairly and their policies are hurting us, well, tariff is a thing to put on the table to strengthen your position. Now, you can overplay your hand. You can. It's better there. In a great world, we'd have free trade. It's deflationary. It lubricates business. We want things exchanging because if no one's buying anything, we're not living well, right? We want free trade. We want that lubrication. And like anything else, there's probably a balance and a yin and a yang, yin and yang to it. So while I hope this discussion is thought provoking, more from an education standpoint than I'm going to tune into the to Andy and hear his thoughts because he's an expert on tariffs. No, that wouldn't be my position. Do I know what they are? Yes. Is it thought-provoking? Yes. Does it provide some wonderful volatility that I love right now? Yes. Does it make the market go on sale? I hope it does more because it's just an opportunity for me to gather more asset. I love the volatility, but I also love the opportunity to learn from it. So don't know if that was helpful on tariffs. But that's my thought on the policies and some of the things I think about. The fiscal impact on our debt and our deficit, the ability to create an income rather than from taxing, and rather than looking at the American people and saying, well, should we broaden the base and tax more people, or should we really go after the rich? And that debate's kind of myopic in there, where we say, hey, why don't we tax China and let them pay off some more of our debt that we've loaned to them? It's an interesting chess game that's above my pay grade. I'm just going to try to produce more than I consume and use my generalized principles to invest. So there you go.
There we go. That's fantastic. Well, we appreciate your take on it. And that wraps up today's episode of Rich Dad StockCast. Tariffs might seem like just another political headline, but as we've discussed today, they have real consequences for investors like you and me. The key is to stay informed, stay strategic, and look for opportunities where others see chaos. And a huge thank you to Andy Tanner for breaking it all down for us. If you take nothing else from this episode, remember this: smart investors, they don't panic, they prepare. Now, before you go, don't forget to grab your free investing resources at stockcastbonus.com. These tools will help you to invest smarter and stay ahead of market changes. And if you got value from today's episode, do me a favor, like, subscribe, share this episode with someone who needs to hear it. Thanks for tuning in to Rich Dad StockCast. I'm Denney, and we'll see you on the next episode. Stay smart, stay invested, and take control of your financial future.
This podcast is a presentation of Rich Dad Media Network.